And again, thank you for joining us here today for Practical Wealth Management. Josh and I look forward to talking about some details in the industry and just how working with an advisor can help you. So before we get too far into it, our compliance team makes sure that we are in line with everything. So here is our blanket disclaimer that none of what we discuss today should be considered advice, and consult with obviously a trusted advisor before you make those personal financial decisions. And any discussion around investment performance that might occur, past performance is obviously no guarantee of what might happen in the future. So feel free to read through that at your own leisure. But as long as you agree to not hold us liable for anything here today, we'll get into it here. Again, as Darla said, my name is Miller Bentley. I am the director of financial services at LGT Financial Advisors. And as Darla said, we also have Josh Orton. I'll let him take it away.
Thanks, Miller. I just wanted to call it. Can you share your screen? I'm not seeing the slides.
Of course.
I think.
How about now?
There we are. I knew not everybody wanted to look at our faces all afternoon. So anyway, I am Josh Orton. I'm a certified financial planner and senior wealth advisor here at LGT Financial Advisors. I feel like there's nothing more to add because Darla did such a great job introducing the two of us. But what I wanted to get into real quick was just a real highlight of our agenda coming today. And I'll give kind of the disclaimer that we're going to be talking about a lot of topics that are very involved, and we could probably spend an hour going into each one of these bullet points. So we're going to keep it very high level today. If there are any specific questions, we have a Q&A. Feel free to drop some questions in there. We can address some of those at the end. And if there's some more general type of questions, or more specific to individual circumstances, feel free to shoot us an email or follow up with us. But that's a quick highlight of what we're looking at today. And so wealth management, you see the other 6 bullet points, but wealth management really is just a comprehensive process. And that includes financial planning, retirement planning, investments, estates, tax planning, and of course, working with a trusted advisor. So let's first start. Miller, can you move forward? Let's look at what is wealth management. And, there's a definition on the screen there from Forbes. Our approach involves these 6 bullet points here on the left side of the screen. But most people kind of think of wealth management just in terms of investing, making me money. And that's certainly a one of the outcomes we're hoping to achieve, but there's a lot that goes into that. And keep in mind, investing and wealth management is not just about accumulating the biggest pile of cash at the end of your life or at retirement. It's about setting goals and meeting those goals. And so, retirement planning and estate planning or legacy planning is what we call it. And insurance, cash flow management, tax planning, these are all crucial components that we're about to hit on. But you can see we could dissect each of those even further. And so this is what LGT Financial Advisors, what we present to our clients. We say, hey, here are the 6 overarching buckets of our approach to comprehensive wealth management. This isn't to say that we need a meeting for each and every single one of these little check marks here. But this is our approach. When we talk about investing, there's obviously much more than just picking investments that go up. There is creating a portfolio and crafting a proper asset allocation, analyzing risk and managing that. There is planning for retirement, understanding how to withdraw money, understanding how long your assets should last you, and how future changes should impact your retirement. On the legacy planning front, obviously, the most basic form of that is, do you have a will in place? Do you have powers of attorney drafted and other medical documents that are meant for you if you're ever incapacitated or deceased? But there's quite a few other things that go into legacy planning. From a protection planning standpoint, that to most people, you hear that and you think, I need insurance? Well, absolutely. Everybody needs health insurance, life insurance, property and casualty insurance. But we could dive much deeper into that and how insurance changes over time, how your needs changes, and so on and so forth. Cash flow while you're working is pretty straightforward. You have your working income, your W-2 income, or maybe it's a 1099 income. But think about flipping that switch into retirement. Where are my cash flow sources now? That's something we want to touch on. And then tax planning. Uh, I could argue, a big pile of money that is not adjusted or not planned for taxes actually is going to last a shorter period of time than a slightly smaller bucket of money that is optimized for taxes and tax planning. So we're going to talk a little bit about all of that today. We're going to get into this a little bit in the weeds, but I'm going to let Miller kick us off here with just comprehensive financial planning.
Awesome. Thank you, Josh. Yeah. When we think about wealth management and kind of where we start, the foundation there is really the financial plan. That's what we view as kind of the roadmap, and that helps guide the decision-making process of both your life and just kind of your wealth progress. So it's really the duty of the trusted advisor to help maximize each client's potential for meeting those life goals through the advice that we give. And so it is an ongoing process, as you'll see here, discovering, and it's a building a relationship and making sure that there really no stone is left unturned, so that the guidance that is given is impactful and meaningful and sets us up on the right path. So all the way from the discovery process to looking at those facts, analyzing, and then that turns into a specific financial plan, and then the delivery process there, implementing what is actually presented, and then that ongoing monitoring, making sure that as life changes, your plan is updated, and that you have every facet of your life working together, kind of like a well-oiled machine. So what that starts with really is setting those goals, having something in mind, something that you are looking forward to, that you want to create with your life. And so that is the driver behind the decision-making process when we get into financial planning. So some examples there, we need to have an emergency fund. So how much money do we want to have, and by what specific year? Or even more a specific date that you want to have that in there. And then working backwards into that, how can we make that happen? Saving more, investing more, whatever it might be. Whatever's important to you, education, supporting a charitable cause, aligning those goals with a plan in place is what's going to set you up for success. And really what we found, obviously, is as everyone can attest to these days, is it's a changing world out there, and financial planning looks different for everybody. Baby boomers right now, they're relishing in their retirement and living on an income that is a little bit different than what they were earning in their working years. And so then we have Gen X and even millennials that are often now referred to as the sandwich generation, meaning that they're feeling the financial stress of not only caring for themselves as maybe a married couple or a single individual, but also potentially caring for a child that is younger than them, and then maybe their adult parents as well, having to provide health care, health services for them, because they might not be able to afford that on their own. So you deal with a lot of different types of personalities and different stages of life. And so financial planning means something different to everybody. And so that's where a tailored financial plan can really come into place and increase the beneficial usage of that plan to be able to make sure that things are in line. All of that ties together, and for one of those goals being retirement. So I'll let Josh talk us through what that looks like.
Yeah, and so retirement planning is really foundational to any sort of comprehensive financial plan or wealth plan. The question, I'll plug myself here because I'm writing an article that's going to be posted to our website here in a few days. But a common question we hear is, how much will I need for retirement, or how much do I need to have saved for retirement? And Google that online, you might see headlines, hey, you need $1 million, or you need to have X amount of money by age Y. And those almost become like nonsensical. When we talk about how much do you need for retirement, I really need to understand, what does your retirement look like? What does your lifestyle look like? On the screen here, we have here, yeah, we have a chart showing, all right, if you do need this, if you did say need $1 million, like some people have heard, uh, how much are you going to need to save on a monthly basis? Well, there it is. And what the really this is showing on the screen here is, you should save and you should invest as early as possible and as often as possible. Saving early and often is a foundational piece and a foundational behavior to having a successful retirement. But on the next slide here, I really need to understand what your retirement looks like. So, if I were to have someone who lived in a rural area in no debt and not a ton of expenses, how much do they need for retirement is going to look vastly different than someone who lives, in a penthouse in downtown Dallas and rents and has much higher expenses. And really, this all becomes what's personal to you. So think about, retirement. How often do you want to spend time with family? Where does your family live? Does that mean you need to travel? Does that mean you need to relocate? I mean, these are good questions that we ask about the monetary impact of retirement. Travel. A lot of people intend on traveling more. Maybe it's, hey, I used to take road trips. Now I want to go overseas. I want to have different experiences. And there's a dollar cost to each of those, obviously, that needs to be accounted for in a retirement plan. On this next slide, just some real basic considerations at a really high level. Think about on the chart here on the screen, you're going to see a bunch of different bars at different pre-retirement income levels on the horizontal axis. And what this is basically alluding to is, all right, when you retire, your living expenses may decrease by a certain amount. And how much of that is going to be covered by Social Security? So you see on the far left, someone who makes $30,000 a year before retirement, well, their expenses might go down 2%. Not really a material change. But keep in mind, Social Security is going to cover 73% of the income needs that this individual has. So there only needs to be 25% of their income that needs to be made up from personal savings or a retirement plan. But zoom out and zoom forward at your pre-retirement income, that $150,000 level, that suggests, hey, your retirement spending is probably going to drop about 20%. But that also means that only a third, 33% of your pre-retirement income is being replaced by Social Security. Where does the other 47%? I mean, that's nearly half of the income that needs to be replaced from somewhere. So that just kind of reinforces the concept saving early and often. If you want to have a bigger or more expensive retirement on an annual basis, there needs to be something that replaces that. And the impact of Social Security is, the more you spend, the less of a percentage that Social Security makes up. Currently, of course, I'll just hit a couple minutes on Social Security. Maybe not even that long, but you're eligible to start claiming it as early as 62 and as late as age 70. But keep in mind, there's 68 million beneficiaries on Social Security, including disability and minors. And the average monthly benefit as of a few months ago was just shy of $1,800 a month. But really, where the numbers show is that Social Security, the OASDI Act, was created in 1939. At that time, the life expectancy for men was 61, and the life expectancy for women was about 65 and a half. And our life expectancy has increased 16 years, by 16 years since 1940. And so people are living a lot longer. Obviously, the impact of Social Security is a huge part of retirement planning. And just this week, they announced there's a 2.5% cost of living adjustment on Social Security. So while that's certainly a good thing and something that we can plan for, it's not, if you plan on if you were a person who had higher income, keep maintaining that lifestyle, Social Security is going to be a smaller component than someone with lower retirement income needs. I'll hit real quick on RMDs. That's basically, those are required minimum distribution from your qualified retirement accounts. But keep in mind, pre-tax versus post-tax. So pre-tax, what that means, tax deferred dollars, that's your traditional IRA, your traditional 401k. There are certainly required minimum distributions. I think right now the age is 73, and eventually it's going to go up to age 75 when those minimum distributions need to start being taken. But there are no RMDs on after-tax money like Roth IRAs or Roth 401ks. So timing those up and having them as a percentage of your entire wealth, understanding that impact of, hey, I've got my pre-tax money, my post-tax money, and then my non-retirement or just taxable money, and figuring out when to withdraw from each bucket is paramount. On the insurance front, prior to age 65, while you're still working, you've probably got group coverage through work, or maybe you've had to go to the marketplace and buy private insurance. But once you're retired and age 65, you're on Medicare. Medicare enrollment in Part A, I just think of that is emergency care or inpatient care in a hospital. That's free. You get enrolled in that automatically. But Part B, where you're actually visiting your doctor, your physician, outpatient services, that is not free. You have to pay a certain amount every month that's going to be deducted from your Social Security check. And that's based on your income from 2 years prior. So you can imagine, if you sold off, an investment property, or, realized capital gains on investments at age 63, you could sign up for Social Security Part B and be shocked at how much you're going to be paying each month because it's looking 2 years into the past. But Medicare Advantage or Part C is kind of bundled together, and usually includes a Part D, and of course, more traditional version of that is just a Medicare supplement plan, which can be used to cover the costs of Part A or Part B that you would normally be paying out of pocket. On the long-term care front, this is a really underserved portion of financial planning. And if anybody has ever talked to a financial advisor, or they're working with a financial advisor for years and years, and they've never broached or breached the conversation around long-term care, I think that's being a really big disservice to you and to anybody really. But you think of the impact of elder care, somebody that's advanced in age, who's the people that are providing that? Usually an adult child, 51% of the time, an adult child is the person providing that care. And that's typically across the board, that's going to be the oldest daughter. That's it doesn't matter what the numbers say. There could be 3 sons, and then the youngest is a daughter, and the parents would receive care most likely from the daughter. And so that's something that familially just needs to be considered and accounted for. That next chart on the right of that, duration of paid care, 65 plus if paid care is used. What this is showing here is, all right, a third of the time for women and 38% of the time for men, this paid long-term care lasts under 3 years. The reason that there's more 3 to 5 years and 5+ years is because if someone has insurance, they're going to use it. And there's more to long-term care than just I'm in a nursing home, or I'm in a skilled nursing facility, or I need assisted living. There's things like in-home healthcare or adult day healthcare that are available. And frankly, the last thing here, the lifetime cost of care, if paid care is used, the biggest bar on there is greater than $250,000. If people are going to be using it for a while, they're going to use as much of that benefit as possible. The last thing on this section before I hand it over to Miller is just talking about life insurance. So I'll hit very briefly on this. the concept of term insurance versus whole life insurance. I'll speak less definitionally about these two right now and just say, as you get into retirement, it's important to understand, all right, if I'm a small business owner, if I have significant assets, or if I have investments that are not liquid, or any assets that are not liquid or should not be liquidated, your estate needs to have the liquidity available to cover any costs or taxes associated with your estate. And if not, then we need to talk about acquiring life insurance. And if for most people, you're in your 60s or 70s in retirement, you may look at your balance sheet and say, I've got, some investments, I've got cash, I don't really have any debt. Everything's publicly traded. I think I'm fine. Do I still need this coverage? We can help you determine yes or no. But from there, Miller, did you want to take over and touch on investments?
Yes. Yeah. Josh, talking about life insurance, that reminds me a quick kind of break, but we were at a conference recently, just both you and I, actually, you were on the panel, and there was someone in the audience at the end of it. That was a great conversation at the end of it. Someone in the audience asked, was a little bit hurt that during the whole conversation, that life insurance wasn't brought up even once. And I think I bring that up because we have a lot of content here today. You just kind of reminded me of it, talking about insurance, but we have a lot of content today, and we're not going to cover every single little detail about comprehensive wealth management. There's a lot of content here kind of for that reason, to kind of show there is a lot that is involved with it. So we are more than happy to talk through the details of that in our process with you personally. But this is kind of the highlights, the what do you call them, the spark notes of comprehensive wealth management today. So we have the Q&A box open as well, and then also our contact information will be at the end. But just a little side note there before we get into talking about investment management. So this is usually what people like to talk about, and what they think wealth management is really just managing an investment portfolio, which this is a part of it, absolutely. And we approach this the same way as we do really the financial plan. So just a couple here basics about investments, just really from the start. What investment types are there? There's common stocks. You see your publicly traded companies, your Apples, Teslas, Googles, Microsofts, and that is the equity piece of stock in those companies. And so then there's also the debt portion, which for some of that you can refer to it as a bond, which is issued and backed by an entity. You can see there municipal bond backed by the Dallas County or Dallas ISD, a corporate bond, debt issued by a company, and then a U.S. Treasury bond, which is debt issued and backed by the U.S. government. So then we also have certificates of deposit, which are debt issued by and backed by a bank. So you can see some examples of what those different investment types are just when we start talking about investments, and really the range of risks involved with those specific types of investments. And we'll talk about risk here just a little bit later, but this is just to show that there are different risk levels involved with different types of investments. You can see there's different types, from mutual funds to exchange traded funds, derivatives, and even alternative investments. And alternative investment landscape can mean different things to different people, but in general, alternative investment is something that's different than traded on the public market. You can see hedge funds there, cryptocurrencies, art, collectibles even are in that kind of alternative investment category. So this leads into then, what type of investment's best? What makes sense? What's hot? What's a hot new stock or something to invest in? Is what a lot of people are interested in. And I think every time that we talk to a client or a potential new client about investing, I always reference this chart. I just think it's great. It's something that it shows year over year, specifically if you're trying to chase returns, meaning if you're trying to invest in something that was hot, last year, or something that performed well last year, usually that is not going to be a beneficial strategy. The other thing is too, there's really this quilt here shows that there's not a whole lot of correlation year over year to the even the different asset classes. But when you look on the far right side of this, the chart, you can see that over the long term, there is a little bit of correlation. You can see those U.S. or the domestic equities are there at the top when we look at the annualized return. So again, I enjoy doing that, at least looking at this chart. This is one that I think is just fascinating. And even the top performers there, you can see in 2018, unless you were in cash, you were losing money. So it's an interesting one to kind of look back at history. What this really kind of all leads to is what do you need? Investing with a purpose, having a time horizon in place, prioritizing your goals. What are you looking to do with these specific monies that you have? Is it retire? Is it provide education? Is it planned spending? Meaning, are you going to buy a house? Are you going to need to purchase a new car? Do you want to have a second home? Whatever that goal might be. First of all, when do you want that to happen? How do you want to get there? And then setting your investment policy in place. Having something we go over and just discuss is risk preference and what risk really means. Risk capacity is that ability to take that risk, but risk preference is, am I actually able to stomach this at night and be able to sleep well? When we talk about risk and how that relates to investments, the volatility, the movement of your investments over time, that's not the risk that we're referring to. And again, this is another good chart. Very, you can obviously tell a little less intricacies on this one, but the real risk there is that you see cost of living is going up, inflation's going up, and your accounts, your spending isn't able to keep up with that. Meaning you're running out of money. That's the real risk. And so we have to make sure that when we're looking at the investment portfolio, we have to consider the goals, the objectives, and the timeline that comes with that in order to make sure that we can meet those stated goals in the future. When we look at investments, again, there's that process of implementing and putting that plan into action, but then benchmarking that plan. What are we measuring this against? It's something that we don't want to be, if we have a portfolio that's more of a short-term investment and we just want it to produce some income or keep our capital in place. Well, we don't want to benchmark that to an S&P 500 index. We would most likely very much underperform that over a long period. So that wouldn't be a viable benchmark. It'd be something more like the Barclays Ag, something that is more income oriented, to be able to say, okay, yeah, we're doing about as well or potentially better than our benchmark there. And then as well, what goes into that as well, benchmarking, and then if need be, making adjustments, but related to the overall goals. Again, it's been proven time again that timing the market is never as beneficial as time in the market. Obviously, this is just really looking at the public equity market, but you can see annualized performance of a $10,000 investment over a 20-year period there from July of 2004 to July of 2024. As long as you were invested for that full time, your annualized rate of return was about 10.5%. If you missed even just the 10 best days over that 20-year period, your returns were 4% less on that, meaning you're looking at there at about $35,000 if you missed the best 10 days, and you're looking north of $70,000 on that initial $10,000 investment if you were invested for that full time. So again, rebalancing, that doesn't mean taking money out, making emotional moves based on what's the headline that's happening that hour. It's rebalancing to your targets that you have in place. And that leads us to, well, what are our targets? What do we rebalance to? And that's where a sound investment policy comes into place. There's things that absolutely should be included in an investment policy statement, and things that we definitely think should not be included in an investment policy statement. And each portfolio should have its investment policy in place, so that kind of the guides there to make sure that what's happening within the investments, within the actual portfolio, is being predicated on by the actual guidelines set out in the investment policy. So when we look at what an investment policy should include, we'll go through these, but it should have an objective, what's trying to be accomplished, a purpose, having the time horizon, or how long we anticipate this portfolio to be in place. We talk about risk, what's the risk tolerance here? Are we needing it to be more aggressive or a little bit more on the conservative side of things? What are the specific asset allocations? And we'll talk about those here towards the end of the program. And then monitoring that plan, again, making sure that what's happening within this policy, how often are we actually going back and looking at the strategy itself and making those changes, and then benchmarking it. How are we performing relative to our specific benchmark? And then again, plan of action. How are changes made? Do we need to go to a board? Is this an individual? Do we need to talk to both husband and wife or both spouses, whatever it might be, to make sure that we can have the changes made on a timely basis? Things that we don't think should be included in investment policy. And usually these are pretty obvious, but something that's based on a prediction or even a past performance, something that's opportunistic, again, timing the market. That's something that, again, a lot of data and reports have been produced that trying to time the market and outperform something based on these short-term guidelines usually is not beneficial at the end of the day. Investment products, meaning that a policy is tailored around a specific product rather than an asset class. And again, we harp on it a lot, but essentially action items based on current market or economic environment, meaning not to completely take that factor out of the equation, taking it for what it is and understanding what might happen here, but keeping in mind the overall goals and the asset allocation and making the adjustments necessary for that long-term time horizon, rather than just what might happen over the next even few hours, as we see in some active managers. As we move on here from investment management, that kind of takes us into estate or legacy planning, and I'll let Josh take it from here.
Yeah, thanks, Miller. It's funny. One real quick thing back on investments. Your chart, the two people, buy, sell. What typically happens. Keep in mind, investors we're all people, and we oftentimes react emotionally. And if you think about what actually happens, and the statistics that say investors typically underperform their benchmarks or underperform the market, and part of that is just behaviorally. If your investments are going up, you're thinking, hey, these are great. I don't ever want to sell or get out of my investments. They kind of plateau a little bit. You say, well, these these have done great. I'm going to hold on to them, and they start going down. And you're like, well, at least I trust the investments. I like these investments. They've done well. They keep going down, and at this point, you're kind of panicking. You're hoping for a rebound, and if things continue to go down, at that point, you hit the sell button and you get out. And then it rebounds a little bit, starts going up. But we're people, and we think, hey, I don't trust this. The market just went down. My investments went down. I don't want to be back in. And it keeps going up, and then you start paying a little bit of attention to it, and it keeps going up, and you buy back in, and you've quite literally done the opposite of what everybody's father or grandfather or grandmother ever told them. You didn't buy low and sell high. You sold low and bought high, meaning you lost money. So just a quick story. Most of my clients have heard me say that, but I always like harping on that. On estate planning, this, to be honest, we're going to talk about planning for death. or incapacity. And so this is our kind of flow chart that we give for our clients. But this is just basically we need a good understanding of what assets are inside your gross estate, what assets are inside your probate estate, how much tax that we can anticipate paying, either to liquidate specific assets or if the estate's large enough to pay estate taxes. We need to know who beneficiaries are and that those are set up properly and that the spouse is considered and accounted for, surviving spouse if the other spouse has passed away. So I like showing this because our clients get a good idea and good picture of where they are. But really, we're going to dive into this. So some really basic estate planning documents everybody should have. This, this isn't something I'll wait until I'm 60 years old before I need to worry about this, or I'll wait until my kids are older and then I'll worry about this. From a really basic level, a will, or what people call a last will and testament, is just a legal document that specifies what should happen. If you have to use a will, that typically means that you're going through probate court, what they call probating the will, where they prove the validity of the will and establish an executor to come in and manage your estate. But that does not provide protection for creditors. You could be subject to estate taxes. It's actually still a public process, and not a lot of protection afforded there. On the flip side of that, higher up on the screen, a trust is a legal contract that specifies what's going to happen with specific assets owned by the trust. That does provide protection from creditors. It does avoid probate and could minimize estate taxes. You get to have a trustee or a manager of assets before you die. You could have someone that knows your wishes and knows how and when to implement those wishes. A lot more flexibility and control with a trust. A power of attorney. There is a power of attorney. There's a durable power of attorney and a medical power of attorney. The durable power of attorney is what most people think of: financial assets, someone to control your bills, someone to withdraw money from your checking account or your savings account to pay your bills or handle your investments. If it's a general power of attorney, that means this person takes over immediately. But most of the time, we see power of attorneys that are durable. It only takes effect if you become incapacitated. The medical power of attorney is what you would think it is, just someone that can direct healthcare services on your behalf. There's also a HIPAA release and authorization where a named individual, likely a spouse or a child, can act as an agent for health matters and allows them to get access to health information. On the next slide, just real quick, beneficiary designations. So think about all of the accounts you could specify beneficiaries for: all of your retirement accounts, life insurance policies, annuity policies. You can have transfer on death beneficiaries on taxable accounts or bank accounts. You could have a beneficiary deed on property. Anytime you set up those types of designations, you avoid probate. What you're really trying to do is set a very clear path for who's going to inherit assets so that you don't have to go to a judge or a court to affect that. There's different levels of beneficiaries. We can thank the Secure Act for that, the Secure Act 2.0. It feels like every year or so, there's more clarification given by the IRS about what is an eligible designated beneficiary versus a designated beneficiary versus a non-designated beneficiary. What I would say is if you're in a situation where you or your family member is a beneficiary and is inheriting some assets or some investments, that you need to talk to either a financial advisor to help manage those and manage the taxes, or you're going to do it yourself, talk with an accountant to figure out exactly what required minimum distributions that you're going to be needed to take. But anytime you name a beneficiary, of course, you can name a primary beneficiary, which is first in line to receive benefits, and then a contingent or secondary beneficiary. and that would be on most retirement accounts, or really any account you can put a beneficiary on. This would come into play, but can also be specified and outlined in a will. Uh, and if let's say your spouse passes away, and you're in a situation where you have multiple children with different stages of life, or one is significantly better off than another, it may be more ideal to leave a contingent beneficiary as a trust, and just let the trustee manage that and manage who gets the money properly. Uh, for your household, let's talk about, imagine that you pass away, and your spouse is grieving, and all of a sudden, hey, we need to go find mom or dad's will, or their medical power of attorney, or whatever document. If you're incapacitated, or if you're deceased, obviously you're not going to be in a position to go get those yourself. But you need to understand where those documents are stored. You need to probably tell your family members where those are. The people who are named and are responsible for carrying out the estate matters, they should know what their responsibilities are, or that they are at least named. You don't want someone to be caught off guard and not able to carry out your wishes. We want to make sure you have up-to-date beneficiary records, have your deeds titled properly. Again, if you own property in your name only and you pass away, that's part of your probate estate. You need to go and probate your will. If you have a co-owner, like a spouse, it'd be pretty easy to say, all right, spouse has taken over this property 100%. They get a step up in basis on your half, and everything's great. But if they pass away, obviously there's no other co-owner. Now that's part of the probate estate. So property deeds can have beneficiaries beyond just the co-owners, and you can have a trust-owned property as well. So there's some intricacies that go into that sort of planning, and so it's important to work with an advisor on that front. But we'll go ahead, skip forward to tax planning. Miller, you want to take it away?
That sounds good. That sounds good. So, tax planning, one of the absolute pleasures we have of having Lane Gorman Trubitt as our parent company is the taxes. We can kind of bounce ideas and guidance off of each other, which is, I'll say, a fun part of the job. But tax planning is a very collaborative effort on that. But you can see tax planning, we're dealing with. This is not a comprehensive list here, but just some of the facets of tax planning and how that is really woven into each decision. Now, you'll hear it a lot that the tax tail doesn't wag the financial planning dog, meaning we obviously have to consider taxes in our decision making, but we don't want that to be the only reason that we make specific decisions. So you can see there are some of the projections that we can do with planning and how we can get into minimizing taxes and what strategies that we can be used. We'll look at a couple of them here. Really, when we look at retirement planning and say, okay, well, how are we going to be most efficient in drawing down our savings to be able to fund our retirement lifestyle? Well, a traditional method would say, well, you use your taxable account first, and you go to your tax deferred assets, and then your tax exempt is last. You can see there that the estimated taxes on doing that is about $59,000. Whereas if we were to do it proportionally each year, meaning taking some from each of the buckets, that can reduce your tax liability by about 36%. Now, that's just one of the many different variables that can come into play when you're thinking about, okay, when I go into retirement, how am I going to be able to fund my lifestyle, and how am I going to do that the most tax efficient way? When we look at charitable giving, gifts to charity are qualify for an income tax deduction depending on a couple different variables. But there's ways that you can take most advantage of what happens in your charitable giving. You can use a specific type of account, a charitable lead trust or a remainder trust, or what really makes it easy is a donor advised fund. And then even going a step further, saying, okay, well, what's the timing of my giving? Should I do what's considered a bunching strategy, or something where I itemize one year and donate a decent amount and a little bit more than usual, and then in my in-between years, I just take the standard deduction and don't do any of the giving. When we look at tax planning for investments, there's many different things to consider. But when we do rebalancing, making sure that there's capital gains are considered long-term or short-term, looking at liquidity as well, making sure that any short-term redemption fees are minimized. Again, owning assets in the right type of accounts. And then as well, reporting, just general tax reporting. Is it K1? Is it 1099? What's an easy experience that also has the most beneficial result? So a lot more obviously on tax planning that we do, but this is just a high level of what that looks like. The last section here, I'll turn it over to Josh just to kick us off, but just, wealth management, we've talked a lot about it, but what that actually means for you when we practice that here at LGT.
Right. Thanks, Miller. And, we're coming up on, I think we've got maybe 12 or 13 minutes left here. So we'll kind of hit some highlights on this section, but if anybody has any questions or you're thinking to yourself, I wish they would have talked about this, or I wish that they could go into more detail about this, or I have questions about, X, Y, or Z, drop it in the Q&A or contact us. We'll have our emails and our phone numbers after the fact, but we'd love to talk with you. How this kind of all plans together and talk about how to work with a financial professional. In our case, as a wealth manager, we could talk about what we can do and what we cannot do. And, this kind of goes back into some of the conversation we had with investments. So we'll just harp on this for a second, but, can't forecast the economy. We can't forecast or time markets. A financial advisor, they can't forecast future performance relative to benchmarks. We don't have a magic ball or anything in front of us, but what we should do and what we can do is increase overall portfolio performance in light of your goals and objectives, and just give you some peace of mind, save you time. And even we do charge every financial advisor has some fee for their services, or they're compensated in some way. But really, our job is to yield a result that covers that fee and kind of makes our services kind of pay for themselves. On the next slide, I'm going to talk about a handful of things that an advisor should have. So if you're working with it or looking to work with a financial professional, or you already are, what you should look at. And so the first thing is skill. Does the individual have sophistication and specialization to help me? In our case, I have the certified financial planner. We have a chief investment officer who's a chartered financial analyst. But you also need someone with the will that has the ability and that wants to spend the time researching, implementing, and monitoring your plan, and not just set you up with some investments and send you on your way. Also the time, someone that dedicates their time to you and spends time listening to you is incredibly important. Miller, do you want to hit us from here?
Yeah, so the other one, obviously, something that an trusted advisor needs to be able to do their job most effectively is the resources, public, private, advisor-only resources that can make sure that the experience they're delivering is at the highest level. And one of the examples when we think about resources here, not just, having the right tools on the tool belt, but we look at investments. And so we look at share class, the cost differences between share classes. First of all, you'll see that top breakdown there, the expense ratio there for the retail investor share class for this one fund is 1.01%. The advisor share class is 0.66%. So not that just that using that one investment is going to make a break even on the cost of the advisor, but it is something that's a significant savings to be able to say, okay, well, my advisor can use this fund, these specific share classes that are even a little bit more beneficial from a cost benefit right at the onset. And then you look as well at minimum initial investments for some types of investments. And when we really look at this, it's usually in relation to private assets. And that's a large part of what we do. And so making sure that we have the availability to use these various products and these asset classifications that are available across the board, even to maybe some of those clients that aren't at that qualified purchaser level, but are at the accredited investor level, and saying, okay, well, this makes sense, and you don't have to have the $1 million to be able to do that. That can either be negotiated by the advisor, or it's just something that's granted to clients of an advisor from the get-go. The other thing as well, using a financial professional to be able to do this, is using correct reporting. And so having something that has a professional look to it, something that's in-depth and detailed. This is a screen grab from a system we use called Black Diamond that each client has access to, and that they can go in and see everything about not just their investment portfolios, but also in their financial plan, looking at their overall net worth statement, and have it right there in front of them is something that we found to be very beneficial. A little overview about the firm. Josh will get into this in the next couple slides before we close out.
Yeah, so real quick about us. Actually, there's a question dropped in the Q&A. I thought I'd answer live, which is just, hey, if someone's interested in working with a financial professional or financial advisor, what's the best way to contact LGT to start that conversation, and how do you match a potential client with the right advisor? The first question there, we're going to have our contact information here on the last slide, so just be on the lookout from that. We'll make sure it goes out. There's a copy of the slides as well. But then how do you make sure you're partnered with the right advisor? I think foundationally, that's going to largely depend from firm to firm. But within LGT, our two client-facing advisors are Miller and I. And so it's about finding whoever the individual that matches best with what your needs are, what you're looking to do, and who has the specialization. Miller and I operate in many ways the same way, but a little bit differently as well. So with the clients that we cover. About our firm, we are a registered investment advisor, but our affiliation with Lane Gorman Truitt is foundational to what we do. It's a highly respected accounting and advisory firm, obviously, and you can see how much we manage in client assets. And last year, we were named a top firm by AUM, by Accounting Today. Our leadership and our advisors, this is kind of just what I was getting to here on slide. There we are. So our managing partner is Don Mader. Hopefully everybody, at least employees, know Don, and many of you on the call know Don as well. We have a chief investment officer, John Bullman, who operates kind of hidden behind the scenes at times, but he leads our investment committee. And then Miller and I are our two senior advisors that are client facing. Our approach, we're fee only. That means we don't have any commissions. We don't have any other sources of fees other than our recurring and ongoing management fee. We're a fiduciary, which means we put our clients' needs ahead of our own interests. And so kind of some of our processes and our thoughts are there on the screen, but from a big picture, we just want to make sure that we're understanding our clients' needs, their goals and their wants, what worries them, and that we develop a plan that addresses all of those.
Yeah, so one of the things that we mentioned earlier was the fiduciary standard, and really what that means is having your best interest, the client's best interest, at the forefront for each decision. And so making those decisions with a duty of care and loyalty, obedience, and prudence really is what encapsulates that fiduciary standard, and what our directive is for each and every client. When we talk about investment management, we believe that the markets our public markets are efficient, that asset allocations are much more important than the specific products selected. And our alpha generation is usually by incorporating private asset classes into the asset allocation investment policy. And also just that public asset classes are better managed, through large and low cost, usually index funds that are going to be able to at least keep pace with our benchmarks with very low margin of error. You can see here when we talk about efficient markets and using large index based funds, you can see comparing seven of S&P 500 index funds over the last 10 years. You can see how narrow of a margin of difference there is in that product selection, and why at least having that asset class is beneficial to adding to the portfolio. When we look at, again, a little bit further with the investments and what an investment policy looks like, these are just some kind of snippets from our investment policy and what that process looks like, what we mean when we talk about an asset allocation and target bands for what we're aiming to do. And then, moving even further on here to comprehensive wealth management, Josh will recap us here and then take us to the end. And I think we might have time for maybe one or two questions at the end, but as Josh said, we can also drop those in the Q&A chat as well.
Yeah, I'll wrap up just by saying, this is we have a screenshot here from our kind of one-page financial plan for a lot of our that we give to virtually all of our clients. And you'll see most people are interested in, hey, oh, look, I have a balance sheet. I've never done one for myself, or I've never understood what that looks like. But really, we put all these components together, and we're trying to get people. Again, this is not a projection of what will happen. This is not supposed to be, you tell me your facts and I'll tell you what's going to happen. This is a decision-making process. Wealth management is, and it's ongoing, exclusive, extensive, and that's our approach. So I do want to thank everybody for joining us today. Our contact information is there. We have a QR code. Feel free to scan, but our email's there. Our phone number is there as well. Miller and I appreciate everybody for joining. Again, drop some questions in the Q&A if you have any, or give us a call, shoot us an email, and we'll be more than happy to help you out.